Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell. I'll be filling in for Stuart Weems. And what I'd like to talk to you about today is land tax. Land tax is the bugbear of property investors in Australia. Look, over the last 30 years, land tax has risen at an exponential rate, and it's now a significant expense for property investors as well as a significant revenue stream for state governments. So look, I wanted to look historically at land tax rates, and going a long way back, the general trend has been for the percentage-based rates to decrease, but the land value thresholds to increase. Let me just explain what that means. In all states, there is a tax-free threshold. So a value of the land up to a certain amount is exempt from land tax, doesn't accrue any land tax. And then once it reaches over that threshold, then there is different percentage-based tax rates according to the value of the land of the property. So as I say, historically, the general trend has been for those percentage-based rates to decrease, but the land value threshold to increase, so which is a good thing. So that effectively reduces the impact of land tax. And you may assume then that would normalise the land tax relative to property prices and rental yields. However, the rate at which these adjustments have been made is well below the rate of property growth in Australia. And in recent years, furthermore, and post-COVID, most states have either frozen their indexation of the land tax rates or decreased the thresholds, as is the case in Victoria. And this has resulted in land tax bills increasing significantly on a relative basis for property investors. The first thing to note is that state-based debt has risen significantly in Australia in recent times, and forecasts indicate that that will continue to rise into the future. And what this means is that state governments are more reliant on tax revenue than ever before. So despite the longer-term historical trend to index the tax rates and thresholds, recent years have begged the question of property investors, well, what would happen if land tax rates weren't adjusted into the future? And that's what I wanted to look into today. So perhaps to start, let's look at sort of justifying this hypothesis, I guess, and look at the historical trends. And I'm not going to do it across all different states because that would take a long time, but I've just honed in on Victoria, New South Wales, and Queensland, and I've focused in on the last 2 decades. So I'm going to give you a bit of a short history, as best I can. There'll be a lot of numbers here around how the land tax rates have changed in those 3 states. So in 2005 in Victoria, the tax-free threshold increased from 150,000 to 175,000, and the percentage-based rate scaled from about 0.1% to 4% over 2.7 mil. And the top rate was also 5%. Then in 2006, the tax-free threshold was increased to 200,000, and the percentage-based rate scaled from about 0.2, the same, to about 3.5% over 2.7. So that's a slight decrease there. Then in 2009 and to 2021, the tax-free threshold was increased to 250,000, and the percentage-based rate scaled from about 0.2% to 2.25%. So then a slight sort of decrease there. And then in 2022 to 2023, roughly the tax-free threshold was increased to 300,000, but the percentage-based rate scaled from 0.2 to 2.55. So the percentage-based rate went up, but the tax-free threshold increased. So probably overall somewhat an increase there, you'd say. And then currently in Victoria, the tax-free threshold has been absolutely reduced heavily down to 50,000, as most Victorian property investors would know. And then the percentage-based rate scale from about 0.3 to 2.65, so a significant increase there. There's been a few early on, back in sort of 2005, some minor decreases there, but then there's been some increases and significant increases in the land tax rates in Victoria. So let's look at New South Wales now. So in New South Wales, prior to 2004, the tax-free threshold was 317,000, and there was a flat percentage-based rate of 1.7%. Then in 2004-2005, the tax-free threshold was scrapped, and then a percentage-based rate scaled up from about 0.4 to 1.4 over 500,000. Then in 2019, the tax-free threshold was set at 692,000, and anything above that, there was $100 plus 1.6% rate applied above this threshold, and then a 2% rate applied above 4.2 million. And then in 2024, New South Wales government removed the indexation of the tax-free threshold, so it's been fixed at $1,075,000, and then above that, you pay $100 plus 1.6% rate, and then 2% above 6.5 million. And let's have a look at Queensland now. So in Queensland in 2009, the tax-free threshold was 600,000, $1 under it. at 600,000, and the percentage base rate scaled from 1% to 1.75%. In 2019 then, the tax-free threshold stayed at 600,000, but the percentage base rate scaled from 1% to 2.25%, so an increase there. And then currently, the 2009 individual rate still applies. However, higher rates for companies and trusts have been introduced since 2019, but we'll disregard that. So there's a lot of numbers there, so let me summarise this for you. So with the exception of New South Wales, that has consistently indexed the tax-free threshold each year until 2024, Victoria and Queensland have left their land tax rate thresholds largely unchanged, which has resulted in significant bracket creep. And so the combined impact of rising property values and bracket creep is clearly reflected in the land tax revenue each state now collects. So over the past decade, New South Wales land tax revenue has jumped from $2.5 billion to $8.2 billion. So that's a 230% increase. In Victoria, it's risen by more than 300% from 1.75 billion to 7.1 billion. And in Queensland, the revenue's grown by nearly 180% from 730 million to 2.5 billion. So on average, land tax revenue across these three states has increased by more than 13.5% per annum over the past 10 years. Now, that's not just due to rising property values. A greater proportion of property owners are now paying land tax than they were a decade ago. Now, just a quick side note, it's interesting that, Melbourne's often criticised for its land tax regime, maybe rightly so. Its land tax revenue has increased by 15% per annum over the past decade, but that's only slightly higher than New South Wales and Queensland at 12.6% and 13% respectively. So, furthermore, Queensland budgets for the highest land tax increase over the next 4 years, an average rate increase of 13.1%. which is almost double the rate of increase in Victoria and New South Wales. Now, this can be largely to do historically with Melbourne property market not doing as well, obviously, as New South Wales and Queensland. But it's interesting, I think Melbourne gets carted a lot for it, but if you look at the sort of historical revenue numbers, they're not out of whack with New South Wales and Queensland that much. And as you'll come to see in just a minute when I present some calculations to you, the Melbourne land tax rates are in 15 or 30 years once properties consistently grow, under the assumption if the land tax rates don't change, they'll actually end up being round about the same as New South Wales and Queensland, and even in some instances lower on a percentage of yield. I'll come to explain this in just a minute. You'll see what I mean. So let's explore the idea then, what would happen if land tax rates weren't to change? So what impact would this have on property yields longer term? So one of the key attributes of investment grade property, which we speak a lot about, is that we need to have a strong land value component. So typically at least 70% of the property value, because, the saying goes that the land appreciates and the building depreciates. So one of the tenets there is trying to maximize the land value component of the property. Of course, there's many other factors involved in securing an investment grade property, but that's one of the keys. So the growth benchmark that we use for investment grade properties with a high land value component is an average long-term growth rate of 7.5%. So that being 5% above inflation. And investment grade properties also typically tend to have lower rental yields, let's say roughly 2% per annum on account of the lower building value component of those properties. Let's look at the rental increases historically. So over the last 30 years, median house rental prices have increased on an average of 4.2% per annum. So assuming these trends continue, we should therefore continue to see land value outpace rental income growth, which mathematically will continue to drive down percentage rental yields and increase the relative impact of land tax over time. So to explore the possible impact of land tax rates remaining unchanged in the future, I've run some calculations based off these assumptions, and also I've just used a very simple dollar figure of $1 million property, debt-free investment property, so let's not include debt, so we're looking at yields excluding debt, and then let's look at them across Victoria, New South Wales and Queensland. Now, in these calculations as well, if we factor in other property expenses, typical property expenses such as rental manager fees, insurance rates, maintenance, etc., let's account for about 30% of gross rental income to go towards those expenses, and then land tax then on top of that. So for this $1 million property, the net yield today before land tax is 1.4%. Then the net yield after land tax in Victoria is 1.15%. And then the net yield in land tax after land tax in New South Wales is 1.4%, so that's better. And the net yield after land tax in Queensland is 1.3%. So that's better. So in current state of $1 million property today, yes, the net rental yields after land tax are better in New South Wales and Queensland. Now let's skip ahead. So based off that assumed growth rate of 7.5% of a good quality investment grade property, that same property in 15 years' time would be worth about $2.7 million in future dollars. And it would then exhibit the following yields. So the net yield before land tax would be 0.9%, so that's come off. The net yield after land tax in Victoria would be 0.64%. The net yield after land tax in New South Wales would be 0.61%, and the net yield after land tax in Queensland would be 0.56%. So as you'll see here, by my calculations, because of the land tax rates in Victoria, once that property gets up to 2.7 million, the net yield has improved. In Victoria, the net yield is better than it is in New South Wales and Queensland, which is quite interesting. And then let's fast forward even further into the future, 30 years' time. So that same property would then be worth over $8 million in future dollars, and it would exhibit the following yield. So a net yield before land tax of 0.57%, net yield after land tax in Victoria of 0.24%, net yield after land tax in New South Wales of 0.9%, and Queensland 0.17%. So as you'll see, overall, the net yields are coming down. They naturally will. They have to mathematically. If property prices increase and that outpaces rental growth, then it just has to. But interestingly, again, Victoria then stacks up as actually the best net rental yield at that price point over New South Wales and Queensland. So what's my takeaway from conducting these calculations? So look, if land tax rates were to remain unchanged or not indexed in line with property growth, I mean, these figures illustrate the insidious nature of land tax on property yields into the future. I mean, those yield numbers in 30 years' time, they're not great yield numbers. So look, we don't have a crystal ball. I'm guessing here, I'm using evidence based off historical data around it, but we don't know what the state governments will do with land tax rates in the future. However, based off historical evidence, it's very unlikely that land tax rates will be adjusted in line with property prices moving forward. And consequently, land tax will continue to creep up on property investors. And I think really this highlights the importance, and this is the point of property, the importance of capital growth over income and investing in the highest possible quality investment grade property. So from my perspective, I think these calculations that I've done, they sort of solidify our view that residential property, it's not an income play. I mean, for anyone that thinks that residential property is an income play, I'd really encourage you to listen to this and to think again. We get approached by potential clients from time to time who describe it to us, this retirement plan in which they intend to build up a property portfolio which will produce enough passive income, a residential property portfolio that is, that'll produce enough passive income to fund their retirement needs. I mean, if land tax were to remain unchanged, looking at the yields above, you'd need to have about a $35 million in property portfolio debt-free to produce an income of $100,000 per annum before tax. I mean, that's pretty amazing. Based off these net yield figures after all expenses and land tax, you'd need to have $35 million property unencumbered to produce an income of $100,000 per annum, and that's before tax, assuming these properties are in personal name. So, I mean, I've said it before, but I don't think residential property is about income. What it's about is leveraged capital growth. I mean, it's a wonderful asset class for wealth accumulation. We obviously love property. I mean, we are asset class agnostic, so we consider all asset classes, but property plays a critical role in a good, well-diversified plan. But I think, a good diversified financial plan, it's got to be spread across asset classes, and it's got to accompany residential property with other assets, so liquid assets that offer more consistent yields. I mean, if you look in contrast, the yields for example, from a share portfolio, they tend to remain very consistent regardless of its size. So in fact, as the portfolio grows, the relative impact of account keeping fees generally decreases, if anything, so the yield can improve. So for example, what I'm saying here is a $1 million share portfolio with a 3% yield would continue to produce the same 3% yield as it grows to 5 million, 10 million, 100 million, doesn't matter, because it doesn't have those increasing expenses and the land tax attached to it. I mean, we speak from experience here because we have some clients who have, particular clients, really large property portfolios, some over 30 mil, 40 mil, that sort of area. And we've done the analysis, Stuart and I, looking at these clients, their yields from their property portfolio, and it's less than 1%. Yeah, it's around about those yields that I discussed above. And really, sort of almost just washing their face from a cash flow perspective. So really, those properties, it's just all about capital growth. There is no income from them, then there's no debt on them, and it's pretty much less than a 1% yield on that property portfolio. So there's real life examples that we've seen outside of these calculations as well. So for us, we think, this sort of solidifies our view around having a diversified asset base. Being all in property is not the way to go. Being all in shares is not the way to go. Being all in on another asset class is not the way to go. But property offers some wonderful benefits in terms of that leverage capital growth. But really, when it comes to then pivoting to income longer term, there's got to be some other assets in there which play that role. Other liquid investments that can be drawn down upon, other ones that don't have land tax, such as share portfolios and the like, and super. So a well thought out plan should have a mix of both. And I think this highlights the importance of working with someone or developing your own knowledge in both asset classes and taking an agnostic view across both asset classes so that you've got some property there, got some leverage capital growth, and you've got some other liquid investments and income producing investments. All right, so I'm going to jump into a few listener questions now. So the first one is from Erik. Erik says, I'm struggling a bit on what to do. Can you give us some advice and clarity, please? We're in our 60s. We're semi-retired. We have one child who's almost 30 with a good job. So in the next few months, Erik is planning to move interstate to be near his child. So selling their current home, buying a new home with cash in this new location. He says we plan to buy a really good property, A-grade, prime location, good long-term capital appreciation, and intergenerational wealth preservation. Good idea, Erik. That sounds great. This will be their forever home. The child might come back to move back in with them, he says. Either way, it's fine. His question is, what would be the best structure to buy this home in? If we were to pass away, I'll pass on this property to our child tax effectively after we pass away. So he's asked, should it be in the name of me and my wife, joint name, or tenants in common, or should we add our child as in tenants in common? Should we be using a trust, or should we be using a company? He also mentions that they have a testamentary trust provision in his will, which is great. So, Erik, the simple answer is I think you're probably best just in joint names. Keep it simple. I don't see any benefit in doing a tenants in common arrangement. In fact, it's probably some drawdowns. I don't see any benefit in having a child added onto the property in a tenants in common arrangement. I don't see the benefit of a trust or a company. And the reason being is because of the main residence exemption. In the event once you pass away and you want to pass this property on to your child, the main residence exemption applies. There's no tax in passing that on to your child. So, you're going to have to pay for some implications that might come about perhaps if you had it inside an entity. I think it's okay, but, it can be questionable sometimes about getting that main residence exemption if it's in a trust or a company, and it's just a little bit more complex. But more to the point, you're going to pay for a structure that you're not using. And I don't see the point in doing it. Really, all the benefits that you want and being able to pass this property on to your child, tax-free, you will get that through just a normal joint ownership. Tenants in common, I don't think you would bother. That creates a situation where when one of you passes away, the other one has to then, there's separate ownership structures. So if you do it 50-50 tenants in common, well, that other person then has to buy out that other person to give that money to their estate. So you don't have to create that situation. Whereas in a joint ownership, it just automatically transfers to the surviving spouse, which is the easiest way, and that's what you want. So really then it'll just get transferred automatically to the surviving spouse. And then when that surviving spouse finally passes away, your child can then sell that property and get the main residence exemption. They have 2 years in which to do it as well. That sort of as a time frame there. You've got 2 years in which to do that, or they can then retain it at that point. So I don't see any benefit, thinking off the top of my head, of why you would do anything other than a normal joint ownership for your home. I hope that helps, Erik. The next question now is from Justin. He's got a few questions here, and they're really good ones. I really like these questions, Justin. So he writes, thanks very much for the well thought out and honest content. I have a few questions about the 6-year exemption rule relating to property ownership. We get a lot of questions about this. So he writes, for context, my partner and I bought an investment property in late 2024 worth 2.4 mil and borrowed 1.95 mil. So I'm assuming they're not living in it now. We plan on living there in 3 to 5 years' time. We're in a position where we could afford to move into the property for 6 months, and I'm wondering if we should do so and have a few questions. So our current rental income from that property is $1,250 per week. That's pretty good rent. So we would be out of pocket by roughly 30 grand over the 6-month period. So if we just make a comment there, Justin, I mean, I don't know, mate, if you're renting, well, yes, you would be out of pocket of the rental income you're receiving, but then you would also be benefited by not paying rent wherever you are living. So I'm not sure. I'm making an assumption here that you are renting somewhere and you're kind of a bit of a rent vesting strategy. It could be that you have another place that you're living in, perhaps, but I mean, then also you could rent that place out. So factor into your budget that if you're paying rent where you're currently living, then you wouldn't have to pay that for the 6-month period. Anywho, I'll move on. First of all, would we then be eligible for the 6-year exemption rule for capital gains tax exemption? So yes, if you moved, short answer is yes, but there is a few caveats here. So if you moved into the property for 6 months, I think that is a reasonable time frame. So there's no clear time frame that's actually mapped out in the tax legislation that says you've got to be living in the property for 6 months or X amount period of time. So it's a bit grey, but really it can't be contrived or seen to be doing it, I suppose, just to get this exemption. You've got to move in and you've got to show some strong evidence that that is your home and you've nominated that as your main residence. So you've got to change your address, on driver's license, banks, mailing addresses, all those sorts of things. You've got to really establish yourself and have it appear as though, have a lot of evidence to the fact that that's your main residence and you're then living there. And if you do all of those things, then yes, a 6-month should be enough period of time if you have genuinely moved into the house and you've got an amount of evidence to show that it is your main primary residence. But let me just stress here, Justin, you've got to be really careful, because there needs to be a genuine reason for occupying the property for 6 months. So a genuine reason for you moving in and then a genuine reason for you moving out other than just the tax benefit. I mean, otherwise the ATO can pull you up on anti-avoidance laws. So, and then in that instance, the onus is really on you to prove otherwise. So there needs to be a really critical and credible reason for moving out. So you can move in with all good intentions, but then in moving out, there needs to be a reason like, it doesn't align with your work, it's not convenient for work, or you didn't realize the cost of living at home, or the mortgage repayments are too high, being non-deductible, doesn't work for your family for some particular reason. And then there's got to be evidence of that. So even potentially emails and communication and showing costs involved in moving to that property as your home. And then it's got to be credible for you going out. So can't be too contrived here, and it needs to be genuine. That's got to be your intention to be living in it long term. Yes, so let me just put it that way for you. And so assuming you then do that, then yes, if that's then nominated as your main residence, you then have the 6-year exemption rule afterwards in which you can choose what property to nominate as your main residence. So yes, you would then have that 6-year window, yes, for the main residence exemption. Justin then asks, while the property is exempt from capital gains under the 6-year rule, can we still claim tax deductions? Great question. Yes, you can. Yeah, it's interesting how this works. You'd think that if you're nominating that property for a 6-year period as your main residence, well, then you couldn't get it. Well, no, actually it works sort of differently. It's more on a cash flow basis. So once that property is rented out and you're receiving rental income, there's tenants in there, it then converts into an investment property. And so then you get all the deductions, all the various interest and expense deductions as you would normally for an investment property. So even though in the background you'd have that nominated as your main residence from a capital gains tax perspective, no, you would, once you rent that out, it would then be tax deductible, all the expenses relating to that property during that period. Justin's next question then is, if we eventually sell the property, do we have to calculate the capital gains by looking at what percentage of time it was owned as an investment without the capital gains exemption? Or could we instead get a valuation before moving into it? So generally how this works, Justin, is if you move straight into a property, so when you buy it, it is your home first. So you move into it and it is your main residence first. And then you move out later and turn it into an investment property. Under that arrangement, you then get a valuation. So it's the valuation at the point of time in which it is no longer, once you've moved out of it and rented it out. So you have to get a valuation at that point, and then the capital gains is calculated from that point onwards. But in the instances where people rent a property first, so it's an investment property first, and then they either then move into it as their home and then stay in it, or in your instance, you've rented it out first, you're going to move into it, make it your home, and then move out of it again, perhaps. In that instance, because it started as an investment property, it's then apportioned. So as you've indicated, the answer is yes. It would be looking at the percentage of time and the percentage time of which. So you would get the exemption, the 6-year exemption. So that would be exempt from that equation by doing that proportionate amount. But it would be total capital gains over the entire period you've owned the property. and then you then proportion out the period of which it was classified as your main residence. And Justin's final question is another really good question. Do I need to notify my bank and tell them that it will be an owner-occupied property, or the loan attached to it would then be owner-occupied property? We wouldn't currently pass their means test to get approved for a long-term owner-occupied property yet. The answer, Justin, is no. You don't need to tell them. And that's, again, a bit of an interesting little funny loophole there. Really, once a loan is settled, the terms of that loan, whether it's principal and interest or interest only, or the interest rates, they're pretty much locked in. And whether you then move in and out of that property, it changes the tax implications, as I mentioned, from a deductibility perspective, and then it has capital gains implications. But from a pure lending perspective, no, you don't need to inform your bank. I mean, something to consider here, Justin, is that if you could switch it to owner-occupied loan, you'd get a lower interest rate. They always are than investment loan interest rates. So you'd benefit from that if you could change it. But I understand you mentioned that from a serviceability perspective, you might not be able to change it to that. But something to look into anyway, because you could tidy up the interest rate a little bit in doing so. Really great questions there, Justin. Thank you very much. That's probably just about as much time I have for today. We're having a few other podcasts in the coming week, as Stuart will be taking some time off, so I look forward to those. But until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.